The number on your screen is $14.7 billion. Not your money, never your money. You are just the one who has to understand it. It is 6:43 in the morning. The market opens and is in 2 hours and 47 minutes. You have been awake since 4 o'clock. Your Reuters terminal glows. Your coffee is untouched. You are reading a 10K filing for a company most people have never heard of. Page 74. The footnotes. The part no one reads. You read it twice. This is where it starts. Not with a trade, not with a thesis, with a footnote. Level 1. You are 22 years old. You have a finance degree and a desk in a research department on the 19th floor of a building in Lower Manhattan. Your job is to build models, discounted cash flows, comparable company analyses, sensitivity tables that no one fully reads. You are not investing yet. You are learning the language. The difference between enterprise value and equity value, between EBITDA and free cash flow, between what a company reports and what it is actually doing. Your senior analyst flags your margin assumptions as too conservative. You rebuild the model. You change the revenue growth forecast by 80 basis points. The price target shifts. You note the revision. You send the update. No one responds until the next morning. You tell yourself this is normal. You are right. You are a function at this stage. You produce outputs, sector notes, earnings previews, valuation summaries. You do not talk to management. You do not attend investor days. You sit at your desk and you read. You read 10KS, proxy statements, industry journals, academic papers on capital allocation that were written before you were born. You are losing sleep. You are gaining something harder to name. Somewhere in the building, a portfolio manager runs $3 billion. You understand on a cellular level that proximity to that kind of thinking is not an accident. It is built. One model, one footnote, one filing at a time. Level 2. You get promoted. Your title changes. Your hours do not. Your base is $120,000. Bonus brings you to $190,000. You start to see the market differently. You are now in the room for earnings calls. You do not speak. You listen. You hear the CFO of a $9 billion industrial conglomerate talk about working capital improvements and what he does not say. You hear the pause before the CapEx guidance. You begin to understand that the information is not only in what is spoken. It lives in the structure of the answer, in the word chosen to replace the word that should have been there. You write your first independent research note. A mid-cap specialty chemicals company. $2.3 billion market cap. Your thesis is that the market is mispricing the margin recovery in their adhesive segment because analysts are using the wrong cost baseline. You are right. The stock moves 18% over the following 6 months. Your name is not on the trade. Your PM's name is. You get an email that says good work. That is it. You tell yourself, this is how it works. You are almost right. Level 3. You are 29 years old. You run a book. Small at first. $80 million. A concentrated portfolio of 12 to 15 names. Your own names. Companies you have read every filing on. Management teams you have spoken to. Industries you have traveled to understand in person. You fly to a tire manufacturing plant in Ohio. You fly to a logistics hub outside of Memphis. You eat bad food in good company and you learn things that do not appear in any document. You make your first significant call. A regional bank in the Southeast. The market thinks the credit quality is deteriorating. You believe the charge-off assumptions are overstated by 40%. You build the model 7 different ways. Each one says the same thing. You size the position at 9% of the book. You are right. The position returns 31% in 8 months. Your fund is up 22% for the year versus a benchmark that is up 9%. You feel something close to certainty for the first time. You file it away quickly. You know what certainty does to investors. You have read enough history to know exactly what it does. This year, you also make one mistake. A consumer discretionary name. You fall in love with the story. You ignore the balance sheet. You hold too long. The position costs you 6% of the book. You do not feel guilty. You feel like you understand the rules now. Level 4. The title on your door says Portfolio Manager. The number in your head is $400 million. That is what you run. You no longer do the primary research yourself. You direct it. You have 3 analysts. You know exactly what their mornings look like. Your process is now yours. Entirely. You have spent 7 years building it. You buy businesses, not stocks. You think in 5-year intervals, not quarters. You look for the same 3 things every time: a durable, competitive position, a management team that allocates capital well, and a price that does not require optimism. You meet the CEO of a mid-sized industrial company at a conference in Chicago. He tells you about a capacity expansion that he believes will double free cash flow in 3 years. Everyone in the room nods politely. You ask him one question, the same question you always ask. What happens if it does not work? His answer tells you everything. You pass on the investment. 18 months later, the expansion comes in over budget by $200 million. The stock drops 34%. Your fund is flat for the quarter. Your investors notice. You protect relationships above almost everything else now, not the transactional ones, the ones where someone has seen you be wrong and stayed. Those are rare. You know exactly how many you have. You sleep 6 hours a night. You are not sure if your edge is intelligence or patience. You suspect it is mostly patience, and that most people in this industry would never admit that. Level 5. You leave the asset manager, you launch your own fund, $600 million at inception, 12 limited partners, institutional capital, a family office from Singapore, a foundation you respect. You are no longer running someone else's process. You are running yours. Entirely. The performance is yours. The losses are yours. There is no one above you to absorb the consequences of a bad quarter. You feel this in a way that is difficult to describe and that you did not fully anticipate. The first year, you are down 11%. The benchmark is down 7%. Your largest LP calls on a Tuesday afternoon. The conversation is calm and professional. It is the most difficult 22 minutes of your career. You do not change the process. Year 2, you are up 28%. Year 3, you are up 19%. By year 5, your fund is $2.1 billion. The performance has compounded at 14.3% net since inception. You have not changed the core of what you do. You have only gotten better at knowing when not to do it. Your fund raises its second vehicle, $3.4 billion, oversubscribed. Your limited partners include a sovereign wealth fund, 2 university endowments, and a pension plan in the Netherlands. Individual positions feel smaller now. You have started thinking about the portfolio as a system. You are not an analyst anymore. You are not sure the word investor fully fits either, but you are not going back. Level 6. Your fund manages $6.8 billion. You run a concentrated, long-duration equity book. You hold positions for an average of 4.5 years. You turn over less than 20% of the portfolio in any given year. You have one position that has been in the book for 9 years. A specialty industrial compounder with operations in 11 countries. You own 7.4% of the company. You sit on an observer seat at the board. You have had the same conversation with the CEO every year for 9 years. The market does not understand the business. The market has never understood the business. You stopped needing the market to understand it a long time ago. This year, you decline to reduce the position, even as it approaches 18% of the book. Every risk committee model flags it. Your head of risk sends you a memo. You read it carefully. You add to the position. The stock is up 340% from your cost basis. You have one regulatory inquiry in your fund's history. Nothing was found. The process reminded you that even doing everything correctly, the system looks at you the same way it looks at everyone else. You filed that away. You now have reputational access, not because you sought it, because the results created it over time. A former Federal Reserve official calls to discuss your macro views. A sovereign wealth fund asks
If you will join their investment advisory committee, you join. You have not spoken to your college roommate in 3 years. Nothing happened. You simply moved in different directions. He teaches economics at a state university. He makes $94,000 a year. You do not know how to close that distance anymore. This bothers you less than it should. Level 7. You are asked to chair the investment committee of a $70 billion endowment. You do not manage the day-to-day portfolio. You set the philosophy. You hire the people who set the allocations. You decide what kind of investor this institution wants to be across the next 30 years. This is a different kind of thinking. You are no longer asking what is cheap. You are asking what will matter. What business models survive the next 2 decades? What geographies? What structures of capital ownership? When the committee shifts its allocation framework, secondary effects ripple through the managers who feed it. You are the framework now. 3 of your former analysts now run their own funds. They allocate in ways that carry your fingerprints without carrying your name. You have a direct line to 4 CIOs at institutions larger than your own fund. As a peer, you restructure the endowment's private equity allocation, $11 billion over 24 months. You do it quietly, in coordination with one other institution. No one outside sees the full picture until it is already done. You are not trading on inside information. You are operating at a level of synthesis that produces foresight. You have not attended a public investment conference in 4 years. You do not give media interviews. You communicate through structured channels, private dinners in London, Zurich, and Abu Dhabi. Very little is written down afterward. Your name appears on an industry list. You have it removed. Privacy, conviction, connection, stillness. These are not things you lost. They are things you exchanged. You made the trade consciously. You are still not sure the terms were what you thought they were. Level 8. No fund required. Your name is on a family office. The family office manages capital across 17 vehicles in 8 jurisdictions. Some are public, most are structured. You have not made a trade yourself in 9 years. You make decisions. 5 people execute them. All 5 have signed agreements that go well beyond standard NDAs. They do not discuss this structure, not because they are afraid, because they understand what it is. A central bank in Southeast Asia is about to adjust its reserve currency policy. You knew 3 weeks ago, not because anyone told you, because you have spent 30 years understanding the architecture of these systems well enough to read the signal before it becomes a headline. Your unrealized carry interest in active vehicles total approximately $1.9 billion. You have a family. You love them with whatever the work has left. You have a house on the water somewhere that feels like another country when you arrive, which is not often enough.
You stopped trusting your own preferences a long time ago, not because you lost them, because you replaced them gradually with orientation, a permanent read of the environment, a constant positioning of capital against uncertainty. You are not happy. You are not unhappy. Those categories dissolved somewhere around level 5. What replaced them is harder to name. It is a condition of permanent attention. You no longer know what you would do if you stopped. So you do not stop. Return. Somewhere below, a 22-year-old sits down at a research terminal for the first time. She opens a 10K filing for a company she has never heard of. She turns to page 74. She reads the footnotes. She thinks this is about finding undervalued stocks. She is already wrong. It was never about the stocks. It was always about learning to see what is actually there, underneath what is reported, underneath what is said, underneath the price. The market does not stop. It just finds new people willing to look.